there that are not correctly priced at any given time. They are either underpriced or overpriced. And especially if you overlay on top of that distress, some kind of temporary situation which affects that business, that will cause even more attenuation of the pricing. Because the other thing that's happening in public markets is that any company typically in about 2 years, sometimes in 1 year, sometimes 6 months, the entire turnover shareholder base changes. So people aren't even holding the stocks that long. So all of these things basically mean that some yo-yo like me can sit there, spend most of my time talking to you guys or hanging out with Dakshina scholars, and every once in a while I see distortions of an extreme nature. And when I see distortions of an extreme nature, then I act decisively. And I don't even need to be right all the time. I can be, in fact, John Templeton, who was a great investor, said that there is no investor who's right more than 2 out of 3 times. So you can be wrong plenty of times, and you can still do fine. So, so I think that you know these distortions take place all the time. I think if you understand the business really well, so the first most important thing is circle of competence. Stick within things that you understand really well. If you understand things really well, you know what they're worth. And when the world is valuing it much below what it should be worth at, that's when you act to buy. And when the world is valuing it significantly above what it's worth at, then you sell it and you're done. Nothing else to do. So maybe you have 2 or 3 buys a year, maybe 2 or 3 sells a year, and we move on from there. Next question.
So my doubt was basically, like, you said that evaluating a potential buy is by throwing a dart.
Yeah. No, please. Abhi, you're putting words in my mouth. Did I say that? I just said by throwing a dart, I can demonstrate to you the wide distortions that take place in stock prices. That's not how I pick stocks.
So then, like, what would be the metrics you use? Like, what financial reports would you use for evaluating the potential? Like,
so number one, I do not throw darts to pick stocks. In case that was not clear, so I don't do that. So let me give you some data points that might be useful. There were a couple of professors in the US, I think one guy is at the University of Nevada, another guy is at Ohio State, and they wrote a paper where they looked at every stock Warren Buffett bought for 30 years, from 1975 to 2005, 30-year period. And what they did is they did an analysis. They said that, okay, if you bought what Buffett bought, and you bought it after it was publicly known that he has bought it, and you bought it on the last day of the month that was publicly known that he had bought it, and you bought it at the high price of the last day of the month, so the highest price it traded on that day, which means that you go and find the worst possible broker on the planet and say, please give me the worst possible price you can get, and I want to buy it at that price. And then you held it till Buffett started selling the stock, and it was known publicly that he was selling it. And you sold it on the last day of the month that it was public, and the price you got when you sold it was the lowest price on that last day of the month. And you did this for every stock that he bought and sold for 30 years. If you did that, you beat the index, the S&P 500, by 11.5% a year on average. And the S&P had done about 10% historically, so you were doing about 21.5% a year with no ISB degree required. And so again, you know, you can walk out of the room right now and you can put this strategy to work, because again, I've told so many business school students about this strategy, and so far nobody has set up a fund to do this. And you know, like you were saying, why are they not replicating? Exactly. Why are they not replicating? So it's still not too late. You can start a fund tomorrow which does this. And what you do is, you take a villa in Goa, and you just go on vacation every day. And then the last day of the month, you come back from the swimming pool and just look at, okay, has Warren Buffett bought anything? Oh, okay, he bought IBM. Okay, chalo, we'll buy IBM. Then you go back to your ocean surfing and swimming and whatever else you're doing in Goa till the end of the next month. And you're done. So the bottom line is that cloning, which I talked about, is a very powerful notion. Unfortunately, no business school professors have ever written any books on cloning that I'm aware of that are any good. And there are a few books on cloning, but they miss the point, I think. So bottom line is that so if you did what Buffett did, what these professors said you should do what Buffett did, you are already beating the S&P by about 11 percentage points a year. Now, most of what Pabrai Funds has done, at least for the last several years, is, in fact, if I look at my portfolio, almost everything that we own was copied from some other great investor. But please don't tell anyone. Let's keep it a secret. Okay? Are we recording this? Vikram, are we recording this? Okay, so we just keep it for internal use. All right, don't put it on the web. We only want ISP to have an edge. Okay, so anyway, so the thing is that if you were to, so basically what I am doing, you can say is a slight tweak to the paper that these professors wrote, where basically if you set up a fund, and all the fund does is clones the ideas of other great investors. But the only layers I add to that is, I don't buy everything that the other greats are buying. I look at what they are buying, and then I look at the ones that I can understand. And the ones that I can understand and figure out, yes, this is very undervalued, and yeah, I think he's right about why he's buying it, those are the ones I'm buying. And that's it. And basically, limited to 2 or 3 decisions a year. That's it. So, not much else required.
CS Balachandra,
yeah,
Company Secretary.
I don't know where you are. Can you just raise your hand? Okay, great. Yeah.
I just wanted to understand the relevance of putting the topic of investing and philanthropies. This is the topic we received.
Yeah.
We are yet to hear about philanthropy.
So if you ask me, we can go there. Do you have a question on philanthropy?
No, we just wanted to hear some thoughts on philanthropy also.
Okay,
because
sure.
we just heard the investing related issues.
Okay.
Compounding and all.
Actually, what you will find, and I'll maybe digress for a few minutes, and not even digress, but I'll go into it for a few minutes. What you will find is it's the same as investing. There's really no difference. So, my personal biases of philanthropy, which I get to play out in Dakshina, are very simple. Basically, first of all, I feel that my father used to say, "Nange aaye hain, nange jana hai." We come to this world naked, we're going to leave this world naked. And so, since we have to leave the world naked, then the question comes up that if you end up with more assets than you need, what do you do with them? And probably a lot of it, because of Warren Buffett's influence, I think that for most people the best thing to do is to recycle it back to society. And so if you decide that you want to recycle excess assets back to society, then the question becomes, how do you do that, and what do you focus on? And so some basic principles. Number one, which comes straight from investing, is that if you were looking at 2 different charitable endeavors, endeavor A and endeavor B, you ought to be able to figure out which one delivers a higher return to society, if you really understand that. And once you figure out which one delivers a higher return to society, what you ought to do is put all of it into the higher return endeavor. So the first thing about philanthropy, my philosophy is, you do not do sprinkling. You do not say, I'll give some money here, and I'll give some money here, and I'll give some money to this temple, and I'll give some money here. No, because that is really not going to maximize and optimize what society's benefit is. So first thing is it has to go single cause, and it has to go to the cause that has the highest possible returns. And in my case, it was very easy to come to the conclusion that that is likely with investments in education towards alleviation of poverty, because I think that education has this a huge multiplier effect. So then you get to the point of saying, okay, I want to invest in education. I want to, instead of giving a person a fish and you feed him for a day, you teach a person to fish and you feed him for a lifetime. And so then the question comes up that if you want to teach fishing, what type of fisherman do you want to create? And so the model Dakshina has adopted is a very high ROI model, because we have a partnership with the government of India. They do most of the heavy lifting. And we get to add on top of a great model. And the returns we get on the funds that we invest, I think, are off the charts. And in fact, to demonstrate that, maybe I can have Ashok come up. Ashok, can you come up for a second? So Ashok Kumar is a Dakshina scholar who is a IIT Bombay student, and you finished 2 years or 3 years there? 3 years. So he's finished 3 years at IIT Bombay. He's actually from Gachibowli. He grew up here, right? And in fact, I visited his home in Gachibowli with my daughter a couple of years back, I think 2 years back. And so Ashok's father is a tailor, and I think it's a lower class area where, lower economic strata area where he practices the profession. Very, very modest dwelling. In fact, when I went to this home, my daughter and I could sit down on 2 chairs, the rest of the family